Today I'm doing what's probably my last video from Ranchos Palos Verdes because I'm leaving LA in about a week from now, guys, and I'll be heading up to Northern California and a couple different areas in between. So definitely wanted to come and show this cool spot because I found this area here that has a park. It's called a Farnham Park. I'll take you guys down there and show you that a little bit. We'll walk around the neighborhood and see what we see here. Now, all these companies, especially the real estate companies, have been releasing their forecasts of where they believe the housing market's going to go within the next year and between now and the end of the year. And Realtor.com just came out with their most recent housing market forecast as well. And basically, this is how they determine their forecast. They say that they use historical housing market and economic data to run their forecast model and make predictions. So they're based on what has happened recently in the housing market and the economy. We evaluate a bunch of different forecast models. From there, the data is weighed with different weight placed on factors such as affordability, income growth versus the growth of house prices to set a forecast. And Realtor.com's forecast is predicting that home sales, the amount of transaction volume, is going to continue to decrease throughout the rest of 2023. And last year, they were way off on their prediction of how many home sales we would see. In 2022, they thought there would be 6.5 million home sales, but the final number was only 4.5 million, guys. So it was actually off by 2 million sales. They predict that this year, there's gonna be 4.2 million sales, which might even be another over prediction because that's not far away from last year's number. And you got to remember, guys, last year mortgage rates were still a lot lower. Even though the peak prices actually got a little bit higher last summer than they've gotten this summer, housing was still technically more affordable when you put it into the context of the house payment was lower due to lower interest rates. Because you got to remember, a year ago, interest rates were hovering around 5%. Today they're around 7.3. So that makes a huge difference if you saw my last video and how much you'll pay for a home, especially the more expensive a home gets. And you know, there's so many people on my channel that say, oh yeah, Michael, home prices are gonna continue to increase. Even Zillow was a recent one that came out and said home prices are gonna increase by 6% this year. Well, Realtor.com originally named that as their same forecast. They originally said, oh yeah, home price is going to increase 6% in 2023. Well, guess what, guys? They've now readjusted that to say that home prices will now drop 0.6% in 2023. So this is the reasoning of why Realtor.com says that home prices are likely to fall now this year instead of rise. They say the reason they expect them to go down is for the same exact reasons they expected them to go up. There's a lot of price support from the fact that there's not a lot of homes for sale and still more than enough demand to take advantage of the inventory that is for sale. This is also leading Realtor.com to change their inventory predictions because originally they thought we were going to end the year with a 20% increase in inventory, but instead they have now revised that to thinking that it's going to be a 5% decline in inventory. And this is one thing I want everybody to understand, okay? Like, people like to grill me in the comments saying, oh, Michael, you've been calling for a housing crash for the last year and a half and nothing has happened. Housing is still expensive, so you're a moron and you don't know anything. Well, look at that, guys. Even Realtor.com, one of the biggest real estate companies out there, is revising their forecast tremendously, okay? They are saying that they believe home prices are now going to drop this year rather than go up, which is a pretty big reversal in their statement. Now, I've still been in the camp ever since I've been saying all of this that I think home prices are going to continue to go down. And guess what? They still have, okay? Have they gone up during this season of the housing market? Absolutely, they always do. And just like seasonality goes, we are guaranteed to see that the second half of 2023, we're gonna see home prices go down again because that's just the seasonality of the market, guys. The other thing that Realtor.com is predicting is that rental prices are going to continue to go down, but they're still going to remain high. So obviously, rental prices, just like the price to buy, has gone up tremendously since the run-up in the housing market. So it's not like rental prices are going to come back down to earth and be affordable again, but it's good news that everything is on a trajectory to go down, guys. And I don't see how anyone can think that that's not good news, because when these companies were originally predicting that home prices were going to go up, and now all of a sudden they're saying they're going to go down, same thing with rental prices and all of this, that's good news for the average person. Another thing that they're seeing is that many of the home searches are coming from out of state, which lines up with Redfin's data as well. You see a lot of people searching to move from one area to another, and likely that's due to the fact that we still have a lot of remote work going on. And at the core of all of it seems to be affordability, guys. Like, even if people make high salaries, they don't want to be stuck with a $7,500 a month mortgage payment. So they're looking at places where they can get in and have a $3,000 or $4,000 a month mortgage payment, which is a smart financial move. So if you ask me, this is one of the main factors that's probably driving the housing market right now. Like, whatever closed sales we are seeing are likely from people that are not from these areas, right? When you see homes selling for ridiculous prices and you wonder who's buying that, it's probably from somebody from somewhere else that makes the salary to actually do that, probably not your neighbor Joe down the street. But overall, the demand for housing is low, guys. It's not like you have a ton of people out there buying homes. It just appears that way because the inventory levels are so low. So when inventory does move, it looks like there's nothing on the market because we already have low levels of inventory. And when things sell, it makes it look like things are still flying off the shelf. But if we were to double or triple the current level of inventory and prices and interest rates remain the same, you're not going to see the homes fly off the shelf. So ultimately, this stalemate can produce affordability, but it's going to take time. And this is likely the reason why we're seeing that 60% of the US housing market hit another record high this year in July. And I'm not surprised, guys. Like, that's the time of year when housing prices are the highest, and it's seasonal. It's seasonal when home prices go up this time of year. It's seasonal when home prices are going to start going down the second half of the year. But the big question is going to be, when next year comes, how much are prices going to continue to go up? Are they going to surpass the highs of this year? Are we going to see that happen without any correction in prices? Or is it finally going to start to fall? Nobody really knows, but I think a lot of it really depends on the unemployment level, which will highly depend on, this recession that we may or may not get, according to so many of the experts, right? But you have to look between the lines, because a lot of this is also being presented falsely, because according to this Black Knight data, you have home prices in June hit record highs in 60% of US markets, okay? But when you really dig in and look between the lines, the amount of equity that people have in their homes is actually still 3% lower than it was a year ago. So why is that, okay? If home prices are up and home prices are still hovering at record highs, why do people have 3% less equity than they did a year ago? Doesn't make a whole lot of sense. Because if the housing market was truly up, okay, and things were really going well, then people should have more equity today than they did a year ago. But it's actually not the case. It's 3% less. And you can say, well, Michael, that's not a huge decrease in equity. It's only 3%. I still have $200,000 in equity in my house that I can tap at any moment, which is what the average homeowner has right now, coincidentally. It's estimated that at this very moment, the current amount of tappable equity in the US housing market is sitting at around $10.5 trillion. And we know that some people are happily taking advantage of this in the form of home equity loans and home equity lines of credit and all this. And if you want to tap into that equity and do something foolish with it, guys, knock yourself out. Doesn't bother me one bit. It's not my problem, it's going to be your problem. And this is another thing we have to read between the lines on, right? So not only are home prices up, supposedly, but equity is down, but also we have this situation where they're saying, don't worry about the people who are underwater on their mortgages. It's only 344,000 current households that are underwater on their mortgages. Only 344,000? That sounds like a lot, doesn't it? I mean, to me, that sounds pretty significant, especially when you look at the fact that according to the Fred data, we only have 613,000 homes for sale on the entire US housing market right now, guys. So that's half. Half of the homes for sale are the amount of people that have negative equity on their houses right now. So how is that not significant? I think that's very significant. The question is, will people that have that negative equity be in a position where they need to sell that home within the next year or two? And I think that just like anybody else, if the economy continues to worsen and the recession really starts hitting people and unemployment starts to go up, the resounding answer is going to be yes. But so far we haven't seen that happen, and I'm not claiming that we have. And it's this type of situation right now that is leading a lot of people to believe that we're heading for this soft landing scenario, where the Fed is going to miraculously raise the interest rates like this, and it's not going to have a huge impact on the economy, and we're just going to skirt this recession and everything's going to go back to normal within a year or two. And this is just going to be the new normal. We're going to have prices being this high in the housing market, wages will continue to go up, everybody lives happily ever after. But here's something that people don't think about or probably don't even know. The same narrative that's being spun right now out there about this whole soft landing and that we're going to dodge this recession is the same narrative that was being spun back in 2007, the year 2000, and 1990, was that there was going to be a soft landing. Here's a quote from 2007 from the Dallas Fed. They said that the United States should manage to make it through the subprime mortgage crisis without a downturn. And we all know how that ended, right? So it's all lies, guys. It's all just false hope, trying to keep people spending, because without the spending, without people taking out more debt, the economy comes to a standstill. And that's the last thing that any politician wants. And because the interest rate hikes have such a delayed impact on the economy, people are still celebrating right now that nothing is really breaking, but it's also still too soon to tell. We have not seen the full effects of the interest rate hikes yet. So I think people who are celebrating that this is a soft landing and we made it through it, no problem, are just celebrating way too early. And here's the reality. In the past 50 years, the Fed has only achieved a soft landing 3 times. And guess what? None of those 3 times were we battling high inflation and had an overheated labor market. So we are literally in uncharted waters right now when it comes to what's going to happen next. And that's why all we can do is make predictions here. Like, that's all I'm ever doing on my channel. I take the latest information that I get for the week, like I always do in my videos, and then I give you guys my opinion on where I think things are headed. And largely I still feel the same on where things are headed. Now, has the housing market crashed and we're down 20% year over year right now? No, guys, we have not had that happen. And the only reason we haven't happened, in my opinion, is because the inventory levels are too low for that to happen. But like I've been telling you, one of these days, that's going to change. We are not going to see this low inventory last forever. And when it does come to an end, that's when you're going to see everything start to turn around. And people are always asking me for my opinion on what I think of this. Should I do this? Should I do that? Should I buy here, sell there, rent here? Like, I can't tell you what to do, guys. Like, I can give you my opinion on things, but ultimately, no one can make these important decisions except for yourself, because only you know your family situation, your financial situation, what your future plans are, and it's always different for everyone. I've done different consulting calls with a lot of you who watch my channel over the years, and every single time I talk to one of you on the phone, the story is always different, okay? It's not like any 2 people have the same exact problems and there's the same exact solution for everyone. And we know for a fact that things are starting to take a turn in the economy, guys, because we already covered that the equity is still lower than it was a year ago, even though prices have somewhat recovered, right? But now we're starting to see the jobs numbers come in pretty low. In fact, the economy only had 187,000 new jobs in July, and the unemployment rate supposedly fell to 3.5%. These job gains that we saw in July are literally at the lowest level that we have seen since December of 2020. And that's still when we were basically just at the beginning of potentially recovering from the crazy pandemic days. So that's pretty bad. And most likely, when these job numbers get revised, as they usually do, this number will probably be even lower than 187,000 jobs. But even with this being the case, the Fed is still saying that, further rate hikes are not off the table yet, guys. And you have to remember another important point from this. According to this economic data, wages rose 4.4% year over year, okay? However, the average house payment is up 19% year over year. So how is that going to continue to last? That's what I want to know. For everybody who says that home prices are going to continue to go up, how does that situation continue? say that happens again next year. Say home prices are right where they're at right now, or maybe even slightly higher, right? Let's say they go up by 2% and wages go up another 4.4%. Oh, fantastic. Now the house payment is 12% higher year over year, but people still only got another 4% in wages. You see how this quickly doesn't make any sense and falls apart? This is like this cool little plaza they have here. So I'm just kind of like meandering through here every time I see something neat. What this jobs report shows us, guys, is early signs that the economy actually is starting to weaken, because this is the lowest jobs report we've had since December 2020. We're also seeing the amount of hours that people are working starting to go down from this. The amount of temporary work that's being hired out is also starting to fall down, which suggests that less and less companies need help right now. Here's what Paul Ashworth, the chief economist over at Capital Economics, said. He said that cyclical sectors of the economy contributed to less than 100,000 additional jobs, pointing to a real economy that, echoing the muted survey-based evidence, is a lot weaker than the pickup in second quarter GDP growth than suggested. So we see these GDP numbers, going up, and people are saying, oh, there's no recession because of this. But the reality is that's not painting the full picture, and no one wants to look at that or admit it. So I think what all this is pointing to is that the interest rate hikes that the Fed has been doing is finally starting to kick in. It's finally starting to show some signs of it working in the economy, just barely, but just the very beginning of it, right? And we're also seeing it with the housing market, guys. Even though we had this miraculous recovery right through the spring housing market, prices are still not as high in many cases as they were last year. There are places that hit new record highs, but there's many that didn't. And like I covered in yesterday's video, there's still many places that are down year over year as well. So I think the best approach to everything at the moment is just to exercise caution, right? It doesn't mean you can't buy a house. It doesn't mean you can't spend money and do things, but it just means that every single financial move that you do make today should probably be a little bit more calculated than in the past, because you never really know what can happen next. You don't know if your credit's going to get tightened up and the bank's going to stop lending you money. You don't know if you're going to lose your job or take a pay cut. You don't know what's going to happen. You don't know if your house is going to drop tremendously in value. So just being mindful of all this and taking precaution, I think, is the smartest thing right now. Of course, people are going to have to make all their own decisions. If you guys enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next one to come out, check out this one on the screen right over here, and I'll see you in the next one.